Welcome back to the show again today, ladies and gentlemen. And what a wild last 24 hours it has been yet again. I know I said that yesterday, but there's been even more wild news over the last 24 hours. Tomorrow's walk and talk, I think, is probably going to be quite a long one just to get in all the small bits, but still vitally important news. But today we're going to focus on a lot of economic news. But before we get into that, I have to touch upon the Boris Johnson Partygate inquiry, or scandal, I guess we can say, because that has finally just been released today. I think it's important that we cover that for a few minutes before we go into all of the financial stuff, which is so important you understand this. We have US, European Union, we have the global report that's just come out, and then we have New Zealand with their new recession that's just been announced. So without any further delay, let's get straight into it. We'll begin with the biggest breaking news then that has just been released. Ex-Prime Minister Boris Johnson of the United Kingdom deliberately misled UK Parliament over parties during COVID. That is what the committee has ruled. Former UK Prime Minister Boris Johnson intentionally misled Parliament over illegal COVID-19 lockdown parties held during his tenure. This report also found that he was complicit in a campaign of abuse and attempted intimidation. This is wild. Of course, Johnson has dubbed the findings both rubbish, absurd, and deranged. He's no longer an MP. He resigned just last week. So the committee has described this as a serious contempt in terms of everything that they have now uncovered. The damning verdict of the Privilege Committee's long-awaited Partygate report found that Johnson had willfully deceived Parliament several times when probed about Downing Street parties that had occurred on his watch and broke his own lockdown rules. Why are we not surprised by this? There is no precedent for a Prime Minister having been found to have deliberately misled the House, it added. I mean, this was a huge report. This was 100 pages where they investigated 6 gatherings, aka parties, which were held at his residence at the time of the most stringent COVID lockdown restrictions. They also found that he was complicit in this campaign of intimidation and abuse and all sorts of other things they're talking about to put pressure on the people that were at the parties not to say anything and to lie. So this is pretty serious stuff. So serious, in fact, that they've actually recommended that he should not even be entitled to a former member's pass. So he can't even go to Parliament is the recommendation. So this, of course, follows all of the police investigations into the parties in the first place. But I wanted to show you this, which I've highlighted here. These parties resulted in fines for both Johnson and who else? The current Prime Minister, Fishy Rishi Sunak, as we know him on here. But yeah, I think they've covered this quite well. It's not the fact that they had these parties during the lockdowns. It's the mere fact that while everybody else was in these super strict lockdowns, the strictest we've ever had, he was actually having parties with other people. I think that is the major thing here. Because do I really care that they were having get-togethers at Downing Street and other places? No, I couldn't care less, to be honest with you. I think the point is, the thing that's so frustrating for us, the general public in the UK, is that people couldn't even say goodbye to their parents, their grandparents, people who were dying. Maybe someone had a long-term terminal illness, cancer, things like that. It could just be simple old age. But I remember implicitly not being able to go to my own grandfather's funeral. And I remember my wife not being able to go and see her father in hospice care. You see, these are the things that we all remember from this event, and that's what makes it so bad and so sinister, I think, in our minds, is that we were all locked down and weren't allowed to do anything, and yet these politicians were having what they called as meetings, but other people call parties. So again, it's the same thing that happens all the time. It's one rule for them and another rule for us. And this is what's causing so much division at the moment. that I'm seeing. It is this one rule for them, this other rule for us. And we're seeing this with things like private jets, for example, as well. We're seeing these incredible high taxes, and now the green taxes and the carbon taxes and all this other stuff, things such as airline flights, but it's across a lot of industries, even on your energy bills and things. Some of you are probably going, what? Is this true? I didn't know this. Yes, there's all these things on your energy bills as well now. But yeah, you have other people like these super rich people, or the politicians who tend to be the super rich these days. How they make their hundreds of millions as a politician is a mystery. But this is the thing, they're flying around their private jets, whereas other people are being told now, oh, we might have to restrict you to one flight per year under the new carbon system coming in the future. You see, this is the problem that we're having, and this Partygate situation only amplifies this further and really shows what the upset is in terms of the public. But the other thing I just want to touch upon, which I think is quite crucial here, is that this goes a lot deeper than individual people. You've got to think of it in terms of a much broader spectrum, because you think about, who can we give an example? Liz Truss, British Prime Minister for what, 6 weeks? She came in, did what she did, and then she went away. The media held her as this hero, and then within 6 weeks she's a villain. Who else was there? Matt Hancock, the health minister. He comes in, he's this big hero. Next thing you know, he's the villain. Now you have Boris Johnson, the hero of COVID. Now he's the villain. So you can't put your trust into people, especially these politicians, and they're all over the world. It's not just, I'm not just being specific about UK politicians here. It's everywhere. It's all over the world. They come in, they make a lot of promises, and then they let the people down whilst lining their own pockets in the meantime. But alas, I'll leave that point there because I want to move on to the important finance news now then. So we've got this that came out last week, which links into all the recent news from the last 24 hours. And this headline is World Economy Set for Weak Inflation Plagued Recovery, and that's from the OECD. And their recommendation, central banks must keep tight policy to defeat core pressures. So their economic outlook is a 2.7% expansion of world output this year, and only a modest pickup to 2.9% next year. Now that is low compared to what it was pre-COVID, because you can see with these black bars here, this is GDP year on year, and then the pink bar is the average from 2013 to 2019. So you can see we are looking at an underperformance for a while, and that includes China as well. We've only got one bar which shows an uplift, and that was the Eurozone for 2022. But another recommendation, and I do agree with this, is that the biggest problem right now is the one they're not focusing on, and that's core price inflation or core inflation, because this is a lot stronger than they expected. It's not stronger than I expected, and if you've been watching here for a while, you'll understand my methodology behind that. And if you haven't seen any of that, you can find it in my private community. The link is below in the description below this video. But this says obviously they shouldn't tighten too much to the point that that would have a greater impact on growth than is necessary. So this is a delicate balance for central banks, but we are today saying they will need to maintain restrictive, here's the key word, restrictive monetary policy until there is evidence that inflation is durably returned to target. And that means core inflation as well as headline inflation. Well, there's two key points there that we need to address. Number one, what is target? Target is 2%. Where did that 2% target come from? There's a long history behind that, but if you actually trace it back, there really is no evidence or methodology behind that. It originated from New Zealand from a long, long time ago. So even that 2% target is pretty bogus, really. There's nothing behind it. The target should be 0%, really, because at 0%, people's savings wouldn't depreciate over the long term. But they like to have inflation because this pays off government debts. But all I see it doing at the minute is pushing up house prices dramatically, pushing up the stock market. Of course, quantitative easing doesn't help either. This is pushing up all of these prices as well. So on one hand, they say they want to help young people to get on the housing ladder and all these other things. But on the other side, they're actually costing them out. Now, the other point with this then is They're also focusing on core inflation, and core inflation is a lot harder to get down than your normal inflation. They're also not talking a lot about food prices, where they should be really, because food prices are having a major problem right now. They're deliberately not addressing this because they don't have a solution to it. What they keep blaming is the lack of food and the shortages that we have been seeing, although you probably haven't been seeing it. If you've got internet access like this, then you are in the Western world, or you're at least in a country where you have money and you have the internet and a computer and things like that. But if you were to go into the developing nations, and you should see some of these reports that I see from missionaries quite regularly, you would not believe the level of hunger and poverty and starvation and other things going on around the world right now. This just isn't put into the public domain. This caution comes a day after the World Bank warned the global economy is in a precarious state and heading for a substantial growth slowdown later this year as interest rate increases start to bite. Yes, because remember, interest rate increases don't impact right away. They take a while to actually hit the economy. They also say that inflation could yet continue to be more persistent than expected, which I would also agree with. Still, it urged central banks to remain restrictive and even raise rates further if needed until there are clear signs that underlying inflationary pressure is durably reduced. Now, I'll come on to an article in a moment, which is this one about the regional banks as to why they can't keep raising rates the way they are talking about, or as this will cause some major issues. Now, they also have some forecasts here for 23 and 24. So this is previous forecast here in terms of growth. And you look at why certain places like the UK saw quite strong growth in 2022. Well, that was similar to EU, similar to other places. There was a lot of new currency creation which helped to create growth. 2023, it's a lot lower. You look at the UK here, only 0.3%. China at 5.4%, and even at 5.1% in 2024. So this is interesting as well, because one thing the media keeps talking about is putting out all this information about how China, Russia, Saudi, the BRICS nations, etc. are experiencing real hardship in their economies and seeing stagnant growth and all these other things. But what's weird about this is that you actually look at the official statistics that are put out by World Bank, OECD, and some of these other reports, and the numbers don't say that. The numbers say, like you just saw there, 5% growth expected. So this is why I say you've always got to dig into the numbers themselves and not just listen to the media reports, because they will steer you in the wrong direction of the actual facts that are going on right now. So we just had the FOMC meeting yesterday. I thought this was quite a good image, courtesy of Mishtalk here, that was published, and I thought this was quite useful because it talks about what we expect to see over the next couple of years. Now, bearing in mind here that just because there's a chart with some dots on it and what they expect, it doesn't mean that will happen. The economy is very intricate, very, very intricate indeed, and that's why we always laugh about the world's leading economists have got everything wrong for 3 years. Every forecast they've made pretty much has been incorrect, because it is very difficult to actually forecast exactly what will happen, because it is human beings that make the decisions, and human beings often make a lot of mistakes. So what we've seen so far is 10 rises in terms of the base rate in 2022, and then what happened yesterday was no surprise at all. Jerome Powell decided to pause on rate hikes for the minute, and that, because they're the reserve currency, the fiat currency, caused other countries around the world to do the same thing, which was to pause, simply take a breath and have a look at what is happening, to then make an assessment of what to do next. And of course, you've got people on both sides of the fence now saying, huge mistake, he should have lowered the rates and stimulated the economy. You have other people still saying inflation's too high, he should have raised them further. There isn't really a perfect solution right now. I, in his position, probably would have done the same thing. I would have paused at this point just to actually see what happens, especially with inflation over the next month, to see what would happen there. But at the same time, the government's got to take action. The government's got to stop all of this destruction of energy that we have now. So you have the energy right now, destroying all that energy and just expecting all of these renewables to be there over the next couple of years when they need it. Because remember, when you're doing explorative work in the energy sector, gas and oil and things like that, these things take a long time to come online. So by blocking all that now, it really is a massive gamble for the United States. But let's go back to the screen a moment here and talk about what I think is most likely then. So one thing he said, which I think was a slip of the tongue, and I can't remember his exact words, but it was something around a pause right now and that he's probably going to do a couple more hikes later this year. I think that is quite likely, and we're probably going to see this rate cap out at around 5.6%, which is high enough to cause some serious damage in the housing market. And then what they're talking about are these 4 cuts in 2024. I'm not so sure if they will do that at this stage, but if they do, I think they're going to be very small cuts. I don't think we're going to get right back down to extremely low rates, which will stimulate growth again. But here's the biggest problem that I see right now with all of this. The regional banks cannot handle any higher rates. In fact, they were probably pulling their hair out that Powell didn't cut rates. They were probably hoping for that, even though knowing that it wouldn't happen. But these banks just cannot handle these rates. And I think it's funny that all of these news outlets are recommending buying these banking stocks now because they're a bargain because they've been hammered. No, they're not a bargain, they're a liability. They've been hammered because there is an underlying risk that is eventually going to show itself and more banks will fail. It is just inevitable. It's a matter of time. We just don't know when it will happen. And what caused this whole situation? It was a triple whammy. First, the higher interest rates meant they had to pay more to depositors, or basically losing access to what was zero rate funding because depositors put their money in and they didn't get a return, which I said was crazy at the time. And it was only a matter of time until this turned around, and now it has, which I think is a good thing because we deserve to be compensated fairly for our savings. The second thing that happened then was these higher rates hit the value of the outstanding bonds. Let's just keep it simple. And that reduced the value of these bonds, causing them to go into negative equity with a lot of their assets. And thirdly then, the banks used to get all of this free money from the Fed. Well, that has dried up as well now. So these banks are really in serious trouble. And right now we have the most extreme inverted yield curve in decades as well. So it all points towards a big problem a little later on. This doesn't mean banks are all doomed, but it does mean, especially if the yield curve stays inverted, that more banks could fall over. The FDIC calculates the unrecorded losses on securities alone amounted to more than 500 billion at the end of March, but across all assets, the unrealized losses of banks due to the higher rates are over $2 trillion. Now, I'm going to be covering all the different inflation rates and interest rates on this month's private community video, and you'll see there's a grouping here, which is where most of you are located, my viewers, and there is a pattern here. We're going to be talking about all of this. And remember, the monthly video in the private community also helps you with my macro course, my stock market course. It helps you with all the forecasts to understand what's happening. If you've got savings, if you've got a pension, if you've got assets, that is what the monthly video is for. It's a complementary resource to these videos on YouTube. Obviously, all of these videos I make completely for free, but the macro monthly video, at least an hour long usually, has a huge amount, at least 30 hours of work put into that video. Over to Europe then, and the ECB hikes rates again and signals rates will rise more before the peak. So the deposit rate has increased to 3.5% from 3.25% as expected. Economists think the tightening campaign will conclude in July, so that is very interesting indeed. And here are the ECB inflation forecast. So we have the black bar here, which was the March projection, and the pink bar is the June projection. So you can see that they have increased their forecasts ever so slightly, or their projection if you prefer. And then if we look at inflation excluding energy and food, you can see that projection is much higher for 2023, 2024, and only slightly higher for 2025. Moving over to New Zealand then, and we go over to Reuters here. New Zealand dips into recession, putting rate hikes in doubt. I would agree with that statement, because when you go into recession, the last thing you want to be doing is raising rates too heavily, because it will only make the recession worse. So their Q1 GDP contracted at 0.1% this year. Their Q4 GDP has been revised to decline 0.7%. We've also had the New Zealand dollar slip against the US dollar today. It's clear that the New Zealand economy is losing momentum. What remains to be seen is whether things have slowed enough to put us on a path back to slow and stable inflation. Employment remains strong in New Zealand, limiting the effect for many people of a recessionary environment. And that is the key thing here, not just in New Zealand, but in most countries, because it's not the official unemployment rate, but I would classify it as people that have income from one or more jobs. So there's a lot of people doing gig work. Some people have 2 or 3 part-time jobs, which is crazy, I know, but this is the new economy that we are living in now. So because so many people do have jobs, even if it is only a part-time job, this is limiting the impact, I think is the best word here, the cost pressure of all of this inflation, food prices, energy, housing, and a whole host of other things. So if we start to see the unemployment rate increase, then this would cause a really big problem, because inflation in New Zealand is still at 6.7%, which is well ahead of what they want it to be. Key line here then, which is pretty serious. The economists actually want to engineer a recession in New Zealand. This is a tactic which is very nasty tactic, I would say. And that is that when they create too much inflation, so here it says to rein in inflation, rather than taking responsibility for this and learning lessons from it, instead they take the same approach every time, which is they engineer a deliberate recession. They try to make it a soft landing, to make it as soft as possible. But this is what they always do. So they create all the inflation through currency creation, and then they engineer a recession as the, I guess, less of evils as they see it, which puts terrible pressure and impact onto families. But because the people just accept it and they just allow all of these things to keep happening and the inflation to keep going, and they don't do anything about it, well, you're never going to see a change while people have this mindset and mentality where all this new currency is created. It goes right up to the super wealthy people on the planet, because that's how money flows. It flows in that direction. Of course, Keynesians say that this results in trickle-down economics. Well, if it does, I haven't seen it very much in recent years. What I've seen is the middle class getting destroyed and the poorest people getting poorer. But alas, I won't go too much more into that, or I'll get a little bit heated on that topic. That is it for today. I hope you enjoyed the video, got a lot of value from it. Apart from that, I will see you tomorrow for the weekly walk and talk. I can't even believe it's Thursday. It's almost Friday already. Until then, take care. God bless. I'll see you tomorrow.